10 o'clock on the dot. Good morning and welcome, ladies and gentlemen. I certainly like to begin today's meeting by first of all welcoming our visitors from the New York Taxi Workers Alliance. If you're here, would you stand and let us recognize you and welcome you to our meeting? Good morning and welcome. Thank you. Thank you for joining us. And I would also like to welcome those of you who are watching on the live stream broadcast. Thank you for joining us this morning as well. I now call this open meeting of the NCUA Board to order. The items on today's agenda include the following: a board briefing on the Share Insurance Fund quarterly report, proposed rule part 704, corporate credit unions. We're going to have a final interagency policy statement, allowances for credit losses, and we will conclude with a board briefing on credit union mortgage rates. First item on our agenda is a board briefing on the Share Insurance Fund quarterly report. Staff presenting Eugene Sheed, Acting Chief Financial Officer. Welcome.
Good morning.
Good morning.
I'm here to present the fourth quarter 2019 statistics for the Share Insurance Fund. Our external auditors have completed the financial statement audit of the Share Insurance Fund for the year ended December 31st, 2019. The fund received an unmodified or clean opinion on the presentation of our financial statements with no reportable conditions. That was also true for the audits of the operating fund, the Community Development Revolving Loan Fund, and the Central Liquidity Facility. In its audit, the NCUA, the KPMG found the financial statements were fairly presented in all material respects in conformity with U.S. generally accepted accounting principles. There were no material weaknesses in internal controls. There were no significant deficiencies related to internal controls, and no instances of reportable non-compliance with laws and regulations in its tested and other matters that are required to be reported under government auditing standards and OMB guidance. The year-end audited statements were posted to the NCUA's website last Friday. In addition to my own team, people throughout the agency work hard on the year-end financial reporting and audit process, and I want to extend my thanks for everyone's contribution. On slide 3, the first table shows the Share Insurance Fund's revenues and expenses for the fourth quarter of 2019. For the quarter ended December 31st, 2019, the fund recorded net income of $50.5 million. Total income of $78.6 million consists primarily of investment income from Treasury securities. Additional income sources include $2.9 million collected for guaranteed fees on the NCUA guaranteed notes, or NGNs. Operating expenses were $47.6 million for the quarter. The provision for insurance losses decreased by $0.6 million during the quarter. The specific reserve decreased by $0.1 million, and the general reserve decreased by $0.5 million. I will discuss the changes in the provisions for insurance losses more on slide 5. The natural person credit union AME loss expenses showed a decrease of $13.2 million due to favorable changes in estimated future cash flow of assets held by certain asset management estates. And the corporate AME expense losses decreased by $5.7 million due to favorable changes in the estimated future cash flows of legacy assets in the NGN program. Moving on to slide 4, the balance sheet. This next table shows the Share Insurance Fund's balance sheet as of December 31st, 2019, compared to the previous year. As of December 31st, total assets were valued at $16.7 billion, of which 95.9% are funds held in U.S. Treasury in cash, overnight investments, and Treasury notes. Overall, total assets increased $847.9 million, or 5.5% for the year, largely due to $640.2 million in capital deposit adjustments for credit unions during the year. The receivable from natural person credit union asset management estates is $342.9 million, which decreased $66 million, primarily due to actual cash collections. The receivable from the corporate asset management estates is $267.3 million, which decreased $22 million from the last year. The decrease is due to cash collections, partly offset by an increase in future cash that we expect to collect. This receivable typically decreases by cash collection for recoveries, such as bond maturities, sales from asset management estates, and legal recoveries. The AME receivable increases for estimated future recoveries from the legacy assets in the NGN program. Accrued interest and other assets of $78.6 million, which increased $13.7 million or 21.1%, is largely due to an increase in Treasury interest receivable. Moving down to the lower part of the chart, total liabilities are $121.6 million, or 0.7% of all assets. Accounts payable and other liabilities of $4.6 million primarily consists of amounts due to the NCUA operating fund for allocated administrative expenses. The share insurance fund's insurance and guarantee program liability or reserve will be explained on the next slide. And at the bottom of the slide, the fund's net position is comprised of capital deposits, which represent the total balances of all federally insured credit unions' 1% capitalization deposit in the cumulative result of operations. The net capital deposit activity increased $640.2 million this year. The balance of cumulative results of operations increased $238.2 million during the year due to, first, unrealized gain on investments of $228.6 million and an increase of $169.7 million for net income, which were offset by $160.1 million for the dividend paid in 2019. Moving on to slide 5, the insurance program guarantee liabilities. The SIF reserve increased in the fourth quarter from $115.9 million to $117 million. The reserve expenses decreased $0.6 million, which is comprised of amounts from both the general and specific reserves. The general reserve expense decreased $0.5 million due to fewer anticipated losses. The specific reserve expense decreased by $0.1 million. Each quarter, the NCUA assesses the specific reserve needs for credit union failures when a loss is probable and estimable. The SIF paid $0.3 million for an assisted merger. The cost of liquidations was reduced by $2 million during the quarter. The reserves at quarter end totaled $117 million, with $6.4 million from the specific reserve and $110.6 million for the general reserves. Moving on to slide 6, the Sif Portfolio. As of December 31st, 2019, the Sif had $15.9 billion at par value invested in Treasury securities with maturities out to November 2026. The weighted life of the securities held in the Sif is 2.9 years. The weighted average yield of securities held in the Sif is 1.88%. Last night, we invested $454 million at a rate of 161 basis points, earning approximately $20,000. The lower bar chart shows the cumulative picture of how much the portfolio will mature over time. About 77% of the portfolio will mature over the next 5 years. During the fourth quarter of 2019, 4 Treasury notes matured in the amount of $900 million. These securities had yields ranging from 1.03% to 2.74%. Next slide, number 7, shows the Sif Equity Ratio. Turning to the equity ratio chart, on December 31st, the equity ratio was 1.35%. The ratio is calculated using an insured shares base of $1.2 trillion at December 31st, 2019. The blue line represents the normal operating level, which was 1.38% in December 2019. Per policy, the equity ratio is updated on a semi-annual basis. Slide 8 provides a little more context into the Sif equity ratio. Per NCUA regulations and rules, slide 8 shows the equity ratio as an abbreviated mathematical formula. From June to December 2019, the equity ratio increased 2 basis points from 1.33% in June. From December 2018 to December 2019, the equity ratio decreased 4 basis points from 1.39% to 1.35%. The primary driver for the change in the equity ratio is faster growth in insured shares of 7.42% as compared to the sum of the contributed capital and retained earnings, which increased at a rate of 4.08%. Moving on to slide number 9, the Camel Information. The number of Camel Code 4 and 5 credit unions decreased by a net of 10 during the fourth quarter of 2019 for a total of 190. Of these credit unions, 88% have less than $100 million in shares. Approximately 10% have more than $100 million in shares, but less than $500 million. And the remaining 2% have more than $500 million in shares. The total shares represented by credit unions that are Camel Codes 4 or 5 is $9.7 billion, or 0.79% of all insured shares. There was a 5 basis point decrease compared to the ratio at the end of the last quarter. On slide number 10, comparing Camel Code 4 and 5 by asset size from September to December 2019, there was a decrease in the number of credit unions with total assets less than $100 million. The number of credit unions with total assets between $100 million and $500 million increased during the quarter, and the number of credit unions with more than $500 million in total assets remained unchanged from the prior quarter. Total shares decreased $0.4 billion, or 4.5%, to $9.7 billion. Total assets decreased $0.5 billion, or 4.2%, to $10.8 billion. Moving to slide 11, with the Camel 3 codes, the number of Camel Code 3 credit unions decreased by a net of 23 during the fourth quarter of 2019 for a total of 838. Of these credit unions, 89% have less than $100 million in shares, 10% have between $100 and $500 million in shares, and 1% of these credit unions have more than $500 million in shares. As of December 31st, 2019, total shares in Camel Code 3 credit unions were $36 billion. This is a $1.7 billion, or 4.5% decrease from last quarter. Camel Code 3 credit unions represent 2.9% of total insured shares at the end of the fourth quarter of 2019, which is a decrease of 22 basis points from 3.2% at the end of the last quarter. On slide 12, comparing Camel Code 3 by asset size from September to December 2019, the number of credit unions with less than $10 million in total assets increased. The number of credit unions with assets between $10 million and $1 billion decreased. The total number of credit unions with more than $1 billion in total assets remain unchanged from the prior quarter. Camel Code 3 total shares decreased by a net of $1.7 billion, or 4.5%, to $36 billion. Total assets decreased by also $1.7 billion, which was 4%, to $41.7 billion. On slide 13, this slide shows the distribution by of assets by Camel Code. The red portion of the chart at the top represents Camel Code 4 and 5. The green represents, in the middle, the percentage of Camel Code 3, and the blue represents the percentage of credit unions that are Camel Code 1 or 2. The distribution of assets over the last quarter increased 0.2% for Camel Code 1 and 2 credit unions and decreased by 0.2% for Camel Code 3 credit unions. Camel Code 4 and 5 credit unions remain the same. On to slide 14. Through the fourth quarter of 2019, there were 2 credit union failures that incurred losses to the Share Insurance Fund. There was one involuntary liquidation with a purchase and assumption and one assisted merger. The cost for failures at the time of liquidation that occurred in 2019 was $40.3 million. As compared to all of 2018, when there were 8 credit union failures, 6 of which were involuntary liquidations with purchase and assumptions, 1 regular involuntary liquidation and 1 assisted merger. The total cost for failures in 2018 was $792.5 million. At this time, fraud was the contributing factor in one of the 2 failures through the fourth quarter of 2019. This concludes my presentations, and I'll be happy to answer any questions.
Great. Thank you for your presentation, Eugene. The quarterly updates on the Share Insurance Fund are an important source of information for the board and the public. It provides transparency into the condition of the fund and provides insight into the health of the credit union industry. If you could return to slide 18 in your presentation, I'd like to point out the fact that the distribution of assets in Camel codes has been on the rise since 2010. To that end, I do have a few questions for you this morning.
Sure.
Your briefing highlights what looks to be continued stable economic activity reflected in the financial statements that are consistent with the Share Insurance Fund's performance this past year. Is this, in fact, a fair assessment of the Share Insurance Fund's health as of the end of 2019?
Yes, I would agree with that. I think as you look through the various financial statements, you should see quite a bit of stability from the end of the prior year, 2018, to 2019. And as you were just referencing, when you look at the Camel Code information, particularly I was looking at it over just the past 5 years, the percentage of assets in Camel Code 3, 4, and 5 credit unions is actually down 50% from that period of 2014 to 2019. And that chart that you're referencing up there, if you look at the percentages of credit unions that are in the Camel 1 and 2, the blue area, so it goes from almost 9% in 2014 to less than, those that are not in the blue go from less than about 9% in 2014 to less than 3% at the end of this last year.
Great, thank you. Did the fund recognize any significant losses in the fourth quarter to the Share Insurance Fund that contributed to the decline in the equity ratio?
No, the decline in the equity ratio was pretty much as the result of the growth of assets, which contributed to the decrease in the equity ratio. And on the reserve slide that was the information presented on slide 5, there were no significant losses during the quarter or adjustments during the year.
Very well. And then I have one final question. What would be the impact on the equity ratio when we do the next round of capital deposit adjustments?
Sure. So based on the increase in the number of insured shares, the insured share level that we saw at the end of the year, we'll be doing billing as we typically do in March and collections in April. At this point, we'd estimate that there would be close to $300 million in collections, which would increase that top part of that ratio. If we don't, we do, as I mentioned, the equity ratio adjustment only semi-annually. As a hypothetical, if we did something at the end of the first quarter when we recognized the revenue, the billings that we were anticipating collecting, it would bump the equity ratio up a couple of points. But then in June, when I present again, we'll have new share growth information, which will tend to depress it back the other way. So those two are always off. We recognize what the industry is doing, and then we bill for it the following quarter.
Very well, thank you, and thank you for your stewardship. I have no further questions. Board Member Harper.
Thank you, Mr. Chairman, and I would like to add my voice to yours at the start of the meeting in welcoming the Taxi Workers Alliance here today. While I would have preferred a public-private partnership, and I can appreciate the anxiety and uncertainty you are feeling related to last night's announcement, going forward, I'm going to be very much closely watching the consumer financial protection and what is going forward in terms of how loans are being worked out, because that's a very important issue for me overall. With that, Eugene, I think this was your first presentation of the Share Insurance Fund at the board meeting with Rendell's. moving up to the Deputy Executive Director's office. I do have a couple of questions on slide 7, if we could go to that. I note that our normal operating level is 1.39% as I look at that slide. Am I correct in noting that for the bank insurance fund, they are actually moving to go to a ratio that's above 2%? So the bank insurance fund has a higher ratio overall, normal operating level, that is.
That's my understanding.
That's great. And also, too, it's also my understanding that in the bank world, there are regular premiums assessed each year based on risk factors and a number of different factors. Is that your understanding as well?
That is also my understanding.
And is that also the case for credit unions? Do we assess premiums each year? Because I don't think we do.
No, we don't. And above an equity ratio of 1.30%, we would not be able to.
Okay, great. Thank you very much, Eugene.
Okay, great. Thank you. Board Member McWaters.
Thank you, Mr. Chairman. I would also like to welcome the New York Taxi Workers Alliance. The announcement we made last evening may have come as somewhat of a surprise to you. It really wasn't. We conserved 2 credit unions well over 18 months ago, and we have been working within this agency and within independent financial advisors to help us discharge our duty as liquidating agents for those credit unions to dispose of the assets under our statutory obligation, which is the least long-term cost for the credit union share insurance fund. So we'd been working for 18 months, and we were on the precipice of closing a deal. And then we found out about you guys in New York. We were interested in that. We sent our senior-most staff to New York to meet with you, to meet with a member of the New York City Council and others. And unfortunately, you at that time were not in a position to fund an acquisition of the medallions. Now, the problem that created for us was that we had transactions that if we delayed them to wait for you to raise funds, if indeed you could raise funds, we would lose those. And we are stewards, we are fiduciaries of the share insurance fund. We're not some hedge fund selling assets. We are representatives of the United States government with a statutory obligation as liquidating agent. And so the decision was made that we needed to take this offer that we had been working on for 18 months to protect the share insurance fund. In those negotiations with the winning bidder, all 3 of us were adamant that the winning bidder needs to act in good faith and fairness and with utmost respect and compliance with consumer protection laws with respect to credit to taxi medallion borrowers and medallion owners. This is critically important to us. I hope you understand that. I hope that you will at least reflect upon the statutory obligation that we had. You know, the share insurance fund has already booked, believe it or not, a little bit over $760 million of losses. Credit unions are comprised of people of modest means, unserved, underserved, middle class, those striving to join the middle class. So members of credit unions are much like you, taxi drivers. These are not the elites of this country. And they have taken a $760 million hit already. And with our fiduciary duty it just seemed inappropriate to put at risk the deal we had. I hope you understand that. We will do our best to continue to work with you. And as Board Member Harper said, monitor consumer compliance with the purchaser and how they treat you, because we want you treated in good faith, fairness, and full strict compliance with consumer protection laws. So thank you very much. After that, it is hard to switch my head back into accounting, but I'm going to try, okay? Let's go to page 7. I note on page 7 that in December, it shows a equity ratio of 1.35. And today we have a normal operating level of 1.38. Okay. Yep. So I feel like there may be some people in the credit union community that see a normal operating level of 1.38 and an equity ratio of 1.35, and they may feel, wow, there could be a premium assessment coming our way of 3 basis points. So I want to go back to what we did when we set the normal operating level at 1.38 and then 1.39 and then lowered it to 1.38 in 2018. In doing that, we set aside 2 basis points for expected declines in the equity ratio. Why did we expect those declines? Because the equity ratio is a formula, and in the formula, the numerator is increasing greater than the increase in the denominator is increasing greater than the increase in the numerator, which drives down the equity ratio. We expected that. We expected that of 2 basis points. So to me, based upon what Mr. Metzger and I did in 2017, we fully expected this. This is the reason we set the normal operating level, and this is fully disclosed in board statements and other things. We set it 2 basis points higher because we expected the equity ratio to go down. So I'm not surprised at all to see this 135 number. Also, we set aside 4 basis points for the NGN notes, and the NGN notes have been redeemed in part and to the extent of at least 1 basis point. That takes it down to 135. So if the normal operating level today is 1.38, you back out the 2 basis points that we expected, that's 1.36. You back out a basis point for redemption of the NGNs as we anticipated, as we wrote 2 years ago, that takes it to 135. So to me, I see a normal operating level of 135 versus an equity ratio of 135. And me personally, not of course speaking for the board, but just for me, based upon the structure that we worked on at the time, there would be no need for a premium assessment. That's all I have. Thank you very much.
Great. Thank you.
Thank you.
And again, to our guests today, I do want to have you recognize that we made every effort to assure you that the purchaser of the medallions will be continuing to work with you in good faith. Just as for the past few years, this agency has worked diligently to help modify roughly 600 loans. We went through a very extensive vetting process, and in fact, there were actually some bidders who were turned away if they did not give us the assurance that they would work with you with good faith in terms of adhering to the tenets of strong safety and soundness. So we want you to recognize that the individual buyers of the loan medallions will continue the effort of working with you in good faith and, again, adhering to tenets of strong consumer protection. With that being said, I'd like to now go to our second item on our agenda, which is Proposed Rule Part 704, Corporate Credit Unions. Staff presenting Scott Hunt, Director, Office of National Examinations and Supervision. Welcome, Scott.
Good morning.
Good morning.
I'm here this morning to present proposed changes to Part 704, Corporate Credit Union Regulations. Specifically, we're proposing to amend 704 to provide greater latitude in selecting board members, more flexibility in selecting a risk management expert, and the ability for corporate credit unions to invest in consumer credit union service organizations, also known as CUSOs. We are allowing for an increased pool of senior staff leaders to serve on corporate boards. We continue to believe that senior leadership best represents the qualified pool of board candidates, but recognize that other positions, such as Chief Risk Officer, Chief Information Officer, may be suitable and valuable to a corporate. Accordingly, we are proposing to remove the specific references to positions and propose redefining eligibility as any senior staff position employed by a consumer credit union. This would include treasurer and manager for smaller credit unions. Enterprise risk management is an essential element to managing the affairs of a corporate, which is why the current rule requires development of a policy and an ERM council. The rule also requires retention of a risk management expert and is prescriptive in defining the qualifications. We recognize that corporates have largely adopted sound ERM functions and continue to make enhancements. While the independent expert enhances an ERM program, it is but one element of many. We believe we can provide corporates flexibility and remove the prescriptive qualifications for the risk management expert and leave greater discretion to the corporate in hiring a person that best fits its needs. Corporates are important service providers to thousands of consumer credit unions. In most cases, corporates provide these services through its charter. However, there are business cases for creating or investing in CUSOs to provide services. In consideration of operational systemic risk to consumer credit unions, corporate CUSOs are generally subject to greater limitations and reporting requirements than consumer credit union CUSOs. The current rule defines a corporate CUSO as any CUSO where a corporate has invested capital. We recognize that investing in a CUSO need not result in control or significant ownership by a corporate CUSO, or by a corporate credit union, There are prudent reasons why a corporate may choose to invest in a consumer CUSO whereby its ownership does not lead to greater risk to the corporate or operational systemic risk to credit unions. Accordingly, the proposed rule affords a corporate authority to invest in a consumer CUSO up to certain limits, without the CUSO being subject to the corporate CUSO requirements. With this change, certain technical changes were added to provide consistency with the consumer CUSO rule. The proposal also incorporates all approved corporate CUSO activities within the rule. Such activities were maintained on the agency's website. This move will promote transparency of the approved activities. And lastly, we're proposing one change to 704 in recognition that the board has approved the proposed rule on subordinated debt issued by credit unions. We are proposing a change to 704 to permit corporates to invest in subordinated debt. However, any such investments will be offset by a corresponding reduction in its Tier 1 capital. This treatment is consistent with other provisions of the rule regarding investments of capital made by a corporate credit union. This concludes my remarks. I'd be glad to answer any questions.
Great. Thank you, Scott, for your presentation. This proposed rule is another important step in the NCUA's ongoing review of its regulations to identify outdated, unnecessary, and unduly burdensome regulatory requirements imposed on federally insured credit unions. In response to the NCUA's 2019 regulatory review, we heard from several commenters that the corporate credit union's rule should be updated. The proposed rule before us today does just that and proposes several targeted amendments to reduce unnecessary burdens without removing the guardrails made to the corporate system in response to the most recent financial crisis. Corporate credit unions play a pivotal role in facilitating operations at thousands of natural person credit unions, especially when it comes to payments. We owe it to the industry to promote prudent rules that balance regulation with corporate credit unions' ability to serve their member owners. The proposed rule before us today does just that. While the proposed rule offers corporate credit unions more flexibility in managing their affairs, it does so while ensuring they continue to operate in a safe and sound manner. I see these revisions as evolutionary and responsive, based on the policies and practices employed by corporate credit unions. One area I have a keen interest in is how the credit union industry engages with fintech companies as it seeks better ways to serve current and future member owners. For this reason, I am interested in responses to the proposal to enhance corporate credit unions' ability to invest in natural person credit union CUSOs. The idea behind this proposal is to permit corporate credit unions more flexibility in partnering with innovative CUSOs with the potential to facilitate adoption of new technologies that facilitate member expansion and lead to a greater array of affordable financial services and accessibility. Scott, I now have a few questions. I am a proponent of sound corporate governance and embrace the concept of enterprise risk management. In fact, when I was here at the NCUA board over a decade ago, I hosted a number of ERM summits. By eliminating the prescriptive definition of independence for the risk management expert, can you elaborate on this change and how it does not impact sound corporate governance?
I'll start with risk management remains a foundational element of safety and soundness through our supervisory activities of a corporate, separate and apart from the prescriptive language and regulation. Also, what the rule retains is important. It retains that the corporate must have a policy. It must have an enterprise risk management council, and it must have an expert. What it's eliminating is the prescriptive nature of the independence of that expert. Also understanding that the rule is relatively narrow in the concept of ERM. ERM, or I should say the rule, does not speak to the quality of policies and procedures. We're silent on that, which is a key element. We're silent to the organization's culture, how it embraces risk management, as well as the organizational structure. How do they create stature and standing of those that are challenging the risk observations within the institution? So look at the totality of the circumstances. While we are eliminating the prescriptive nature of independence, it's also with the context of all the other, say, belts and suspenders around risk management that still exist. And then there's one operational concern by removing the prescriptive nature. The way the current rule reads is that there has to be independence of the CEO, basically in structure and in financial aspects. Contemporary risk management, you oftentimes see a chief risk officer as the point person over this. It creates that stature. Very common for that CRO to report directly to the CIO or CEO, as well as maybe a board or a sub-council of the board, which is healthy. So this would open up that ability for that CRO to be that independent risk expert in the construct of an ERM program at a corporate.
Great, thanks. And Scott, as I sit here with you this morning, it just dawned upon me, this is, I know in my 10 months here, you haven't presented before the NCUA board. So with that being said, do you mind giving us and maybe the industry a brief update on the health of the corporate credit union system?
It may be fitting because I do look back on your tenure here in 2009. I think thereabouts where it ended, and we were in a little bit different spot with the corporates. It's a much different story today. If nothing else, the corporate industry is now down to 11 corporate credit unions after consolidation, which has sort of tempered itself a few years ago. The industry is about $20 billion in aggregate assets, fluctuates according to the liquidity of the system. It's currently $23 billion at this time with a recent influx of shares. The Tier 1 capital exceeds 8% on average and is as high as 12%. Significantly above the 5% well-capitalized ratio prescribed by the reg. Profits are very robust. We're looking at an average of about 60 basis points in an industry that is very margin dependent. Looking back 10 years ago, profits of 25 basis points may have been deemed healthy at that time, so they've certainly rebounded. And lastly, we have no investment action plans, and that speaks to them complying with all the rigors of the ALM concentration and credit risk requirements of 704. They're in a much healthier place there.
Great, thank you. I have no further questions. Board Member Harper.
Thank you, Mr. Chairman. And Scott, when we met, I guess it was last week, I appreciated the assurances that you provided me of both yourself and representations of your staff that while this is an evolution on enterprise risk management, we will still be very much focused on the supervisory side of enterprise risk management. And I look forward to those comments as they come in on this proposal in case there are any unintended consequences on this point. I do have one question, and the chairman noted that this is a rule that is evolving from our every 3-year review process. I'm interested just publicly, we talked about what we've included in this rule, but there were other ideas that were presented out there that we left out. And I was hoping maybe we talked about this, about some of the ideas that were left out and not included in this proposal and why staff made those decisions.
So routinely, my staff and I do meet with the corporate leadership. I think it's a healthy dialogue where we get to share ideas and challenges. They provide a suggestion where they may seek relief. I may provide an idea of why I have an agreement or disagreement, and also just understanding how their business is evolving and how we may need to adapt any practices within our supervisory regime or the regulations. One area that they have in general looked at is an expansion of investments to be less prescriptive or create more flexibility so that they can in turn perhaps increase margin to perhaps increase some measures of liquidity to their members. At this time, we haven't felt the compelling need. One is, I just reiterated several stats that showing within the construct that is there, they're doing very well. The capital is being built. Strong earnings are there. They continue to serve that pivotal purpose of operations, daily liquidity management, payment services, which is critical to the thousands. And with that, I probably should have started with this. We always recognize their role, the systemic operational importance they represent to the thousands of smaller credit unions. And within that charter, it's always important to have that in your mindset when constructing all the other rules around what they do. So there may be a future time when we would entertain more liberties, and as they continue to build profits and there's other evolutions in the next few years, we can certainly entertain it at that time, but not right now.
Well, and Scott, I appreciate that, and certainly we've, if anything, have learned a lesson from the last corporate crisis, where they had certain liberties, as you described it, that got the entire system into trouble, and we need to move carefully and judiciously in that regard. And I appreciate your analysis there, Mr. Chairman. I have no other questions.
Great. Thank you, Board Member McWaters.
Thank you, Mr. Chairman. Scott, as you and I have discussed over the years, it's now 2020. It's not 2008, 2009. 2008, 2009, we placed fairly severe regulatory constraints on the operation of corporate credit unions. I think at that time that was an entirely appropriate thing to do. And if anything, it helped save the corporate credit union environment. Over the years, you and I have worked together, and we have proposed changes in the corporate credit union rules, which again are reflecting the report you just now gave at the request of the chairman about the status of the corporate credit union community, that it's in good shape today, and you're the guy who looks at it. So with that in mind, that it's not the midst of the corporate crisis, the corporates are not falling apart, that we have made changes to these rules that have in effect liberalized them, but there's been no adverse effect or consequence of that. I look at these rules as another step in that continuum. You know, we take this step, if these rules become final, there may be another step, but it will only happen, as far as I'm concerned, if you're able to report to the board still in good shape. So thank you very much.
Great. Is there a motion?
Yes, I move that the board approve proposed rule, Part 704 of NCUA Rules and Regulations for a 60-day comment period as attached to the board action memorandum.
Is there a second to the motion?
Second.
There is a sufficient second. All those in favor say aye. Aye. And those opposed say no. Let the record show the motion passed 3-0, and thank you again, Scott Hunt.
Thank you very much.
The third item on our agenda today is a final interagency policy statement, Allowances for Credit Losses. Staff presenting Scott Neat, Associate Director, and Allison Clark, Chief Accountant, Office of Examination and Insurance. Welcome, both of you. Thank you for joining us.
Thank you. Good morning, gentlemen. We're here today to seek approval to issue in the Federal Register the final interagency policy statement on the allowance for credit losses, otherwise commonly known as CECL. By way of some background, work began on this CECL interagency policy statement back in 2018 when the FFIEC's Task Force on Supervision authorized a project to determine what interagency guidance required updating as a result of the Financial Accounting Standards Board, or FASB, introduction to the new accounting standard for expected credit losses. The task force determined we first needed to update our 2002 and 2006 guidance for the allowance for loan and lease losses to incorporate CECL. Allison, our NCUA's chief accountant, was the lead on this project for NCUA, so I'll now turn it over to her to provide some more specific remarks on the CECL interagency policy statement and other related work streams.
Thank you, Scott. The 2006 guidance was an interagency product. The 2000 guidance not only addresses allowance for credit losses, but also includes an attachment, otherwise referred to as Attachment 1, which was specific guidance pertaining to the credit risk and review function. During initial discussions among the interagency participants, we decided to separate into two complementary interagency policy statements, one, the accounting guidance for CECL, and the second, guidance for the credit risk review function. These two proposed interagency policy statements were issued for public comment in October of 2019, and we collectively received 23 comment letters on the CECL interagency policy statement. I am pleased to announce that our credit union industry sent in nearly half of those comment letters, numbering 10. The CECL team then analyzed these comments and incorporated changes to the policy statement as warranted. Comments and concerns brought forth by the credit union industry have been addressed either in the preamble or within the body of the policy statement itself. In particular, credit union concerns regarding regulatory net worth were addressed in the preamble under a specific heading titled Specific to Credit Unions. I would like to note that the other team working on the credit risk review guidance is nearly complete with their work developing the final guidance, and the agencies hope to be able to issue that guidance in the near future. As such, we are here today to seek board approval on the CECL interagency policy statement. I'd like to bring to your attention the substantive changes between the proposed and the final policy statement. First, we removed the table of contents. Unfortunately, the Federal Register formatting did not lend itself well to allowing to have a table of contents. Two, we listed in the proposed policy statement many qualitative factors and risk characteristics that could be used to segment and evaluate financial assets. However, commenters wanted more specific Q or qualitative factors related to held-to-maturity debt securities. So we added some risk factors that could be relevant for held-to-maturity securities, such as the coupon rate and payment frequency. Third, we removed the specific classification of credit expense for off-balance sheet liabilities on the income statement. This provides more flexibility for the agencies in the future as to where on the income statement this expense is recorded relative to the call report. And third, we added language to clarify the auditor independence issues when an external auditor does both the validation of the estimate and the audit. With that, I'll turn it back over to Scott for some concluding remarks.
Thank you, Allison. There are a variety of additional work streams related to CECL that are ongoing in NCUA and on an interagency basis. We continue to work closely with our peer banking agencies, FASB, and the AICPA on CECL implementation and education matters. We will continue to issue additional guidance to provide additional clarifications as necessary. We will also continue our efforts to educate credit unions about CECL, in particular helping smaller credit unions understand acceptable methods that are less burdensome operationally to implement CECL. That concludes our prepared remarks, and we'd be happy to answer any questions you may have.
Great. Thank you both for your presentation this morning. I certainly appreciate your work on this interagency guidance and the time and dedication spent on the CECL interagency policy statement. I also appreciate comments from the credit union industry that will help strengthen this interagency guidance. And Alice and I was glad you let us know that there were at least 10 of those letters were indeed from the credit unions themselves. This updated guidance will provide credit unions with important information and clarity about how to apply CECL. And of course, I will be supporting this proposal this morning. I recognize that CECL has, in fact, though, caused some trepidation amongst credit unions since it is a departure from how credit unions have been estimating credit losses. I know you've worked with FASB to provide clarification and training on practical methods for credit unions and community banks to calculate estimates under CECL to reduce the associated operational burden. Given the concerns over the operational complexity and associated costs to implement the new standard, I was pleased with FASB's decision to delay implementation for non-public benefit entities, also known as PBEs, until January 2023. Also, the NCUA has done a number of things to ensure credit unions are prepared for CECL, including participation in the FIFIAC's CECL project, credit union examiner and awareness initiatives, and updates to guidance, examination procedures, and policy changes. However, we recognize that the NCUA has additional work to do to educate credit unions and our internal staff on CECL. Given that the median asset size for credit unions is only about $35 million, I want to make sure that NCUA does everything it can to provide as much information as possible, coordinating with our peer regulatory agencies and the accounting industry. I now have a few questions. You mentioned clarification around independence issues. Could one of you please elaborate on that a little more?
Sure. First of all, the requirement for validation of the estimate has not changed between the 2006 guidance and this CECL IPS. That said, I wanted language in the IPS that explicitly stated independence may be impaired and not that it was a foregone conclusion. Only credit unions above 500 million have to have a certified opinion audit. And for those credit unions, a state licensed auditor could not do both the validation of the estimate and render an opinion on the financial statements due to independent standards. However, for credit unions less than 500 million, they might actually engage a league or an NCUA a retired NCUA examiner to perform their audit of the other supervisory committee audit function. And those credit unions refer to those individuals as auditors. However, they are not precluded and under the same independent standards as a state licensed person. Additionally, a state licensed person performing an agreed upon procedures engagement might actually consider doing both the validation of the estimate as well as the audit, because they don't have to render an opinion on that, nor are they exercising any judgment in those agreed upon procedures.
Great, thank you. And as I read and reviewed the 10 comment letters from the industry, there was in fact a common theme that seemed to request credit union specific education on CECL implementation. Do we as an agency have some specific plans to meet that need?
Yes, sir, we do. I'm excited to announce that we will be launching a CECL webpage in the not too distant future on our NCUA public facing website. I anticipate that will be up before the end of the first quarter. And on that will be this IPS and possibly the opportunity to reinsert the table of contents that had to be eliminated due to the Federal Registry formatting issues. There will also be other links to CECL related resources, including that webinar that we did last April, highlighting the weighted average remaining maturity method, or otherwise known as the WARM method. We are very committed to keeping that page up to date as information becomes available. We plan to be very receptive to the credit union industry related to other issues and clarification requests, providing whatever education that we can. As you well know, the big banks went live with CECL in January. I fully expect us to have some lessons learned towards the latter part of the year that we'll be able to disseminate to credit unions. Lastly, we are very dedicated to assisting our credit unions as much as possible, as is the Financial Accounting Standards Board, FASB. In fact, they continue to hold workshops all over the country, educating smaller institutions. And last year in 2019, the FASB let me know that 120 individual credit unions participated in their workshops, learning how to do spreadsheet methodologies and answering specific questions for them.
Great, thank you. And I do have just one final question. In fact, I announced late last year that the NCUA has the authority to phase in a day one adjustment to net worth when CECL is in fact implemented. I know credit unions don't have to implement CECL until January 2023, but what are the plans?
I'll take that one. You're correct, Chairman. We've been working with our Office of General Counsel to develop a proposed rule that would phase in the impact on CECL for net worth. This is one of our priorities that we're working on for 2020. Our goal is to get a proposed rule back before the board in the second or third quarter this year. So hopefully we can finalize it by the end of 2020.
Great, thank you. And thank you most importantly for the ongoing training and education efforts that you're working on, and also for the stakeholder engagement. I'd like for you to know, just as you all are meeting with FASB as other stakeholders, I too, as chairman, am meeting with FASB, AICPA, SEC, and other folks that are really engaged with the whole CECL implementation effort. So again, thank you. I have no further questions. Board Member Harper.
Thank you, Mr. Chairman. And Allison and Scott, thank you for your presentation and your hard work on this final interagency policy statement related to current expected credit losses. And I think, Allison, this is your first time at the board table?
Actually, sir, it's my second time to the board table, but the first in front of you and Mr. Hood.
You did a terrific job.
Thank you.
I'm pleased that this matter is before us today, but I do want to follow up on the chairman's last question. I, for one, would prefer to see us move forward in the second quarter with a day one mitigation rule related to the capital treatment on CECL. I think that credit unions very much would like to see sooner rather than later what our expectations are so that they can make plans. And I think it would behoove us to be transparent and move as quickly as possible on that overall. I do have one question for the two of you. On page 53 of the policy statement, it explains that certain credit losses should be based on management's judgment. And then the policy statement further explains that those evaluations by management are subject to review by examiners. That's going to cause uncertainty for credit union managers who would prefer a bright line test. So would you walk us through what the standard of review will be for NCUA's examiners related to these evaluations?
Sure, I'll take that one. The examination process under CECL will be very much like it is today under the current accounting standards. It's management's responsibility to develop a reasonable, supportable methodology to support their allowance for loan and lease loss account. It's our examiner's responsibility to review that methodology and determine if it's reasonable and supportable. That's going to be the standard going forward, and it's our expectation if management has presented a reasonable methodology that our examiners would accept it and not question the amount that it determines needs to be in the allowance for loan and lease loss account.
And Scott, following up on that, a reasonable and supportable method, does that mean a credit union needs to go out and hire a vendor or an econometrician to do this?
We've said from day one that we do not expect any credit union, especially our smallest credit unions, to hire a third-party vendor to help them develop this, or to hire or buy a software package to compute this for them. Our goal and our expectation is that, particularly for our smaller credit unions, they should be able to do this methodology, or whatever methodology they determine, on a spreadsheet, just like many of them do today. And I know Allison is committed to providing additional examples of simplistic type models in addition to the warm method that we're going to put it on our website for our smaller credit unions as examples.
Many thanks for that answer, Scott. I think that that's a very helpful point to make. Chairman Hood, I have no further questions, and at the appropriate time, I will move the question on
Well,
this
great.
matter.
Thank you very much. Board Member McWaters.
Thank you, Mr. Chairman. And Allison, I got to tell you that I am thrilled to hear about this Cecil webpage because, you know, occasionally at 3 o'clock in the morning, you just wake up and you just can't get back to sleep. And now I know where to go. Okay. And so this is fantastic. But in all seriousness, this phase in of the Cecil method is very important. Because what Cecil does is it takes the allowance for loan and lease losses and it requires a computation over the life of the loan as opposed to simply incurred losses. The life of the loan losses are going to be greater. If that's booked to P&L, then it gets closed into retained earnings, lowering retained earnings, which lowers regulatory capital, which lowers the ability of a credit union to hold assets with sufficient regulatory capital. So while we can sit around and say, well, you know, we're going to get this done, if you're a credit union and you're looking into the future and you've already done projections on what your Cecil number will be and how it will close to the balance sheet and affect your regulatory capital, you would just as soon have the knowledge that, yes, you can take that day one charge, and instead of taking a hit on day one, you can amortize it over 3 years. When I first proposed this idea to the FASB, that they, in effect, do that, and they said, well, why don't you guys do that? And I said, you know, fine. But I would have liked it to have been a longer period of time. I mean, they did this for goodwill. That was 10 years, and I thought 10-year phase-in made a lot more sense. But 3 years is better than a day one hit. But I agree, it would help the credit union community if they knew they had a rule on the books that allows day one hits under Cecil to be amortized over 3 years sooner rather than later. Also, on the reasonable and supportable, I mean, this is very important because the way Cecil was originally written, it seemed to require everyone go off and find some PhD from MIT that could advise them on this. You know, Andy's around here somewhere. He's the only PhD I know. So in this room that could do this. These guys are not cheap. So I am pleased that the FASB has relaxed that. But what's important is that relaxation work its way down into guidance that is very clear to, let's say, the local or shopping center based accountant that may be auditing and signing off on financial statements of local credit unions. It's not going to be any good if we understand that's the way it is, or if the big four accounting firms understand that's the way it is, but it needs to trickle down all the way to the local credit CPAs. Is that your understanding that that's actually being done? I mean, I've voiced it. I know others have too.
Yes, that is my understanding. The AICPA has just issued an audit practice guide specific to Cecil, and so that's available to all CPAs and people who are not state licensed can grab that AICPA audit practice guide off of the AICPA website. Okay,
so to the extent people have not noticed that or are unaware of its existence, I assume that on our Cecil webpage, we are drawing a map right to it.
Yes, there will be a link on our webpage for that AICPA practice audit guide.
Okay. Thank you very much. I have no questions.
Great, thank you. Is there a motion?
I move that the board approve the final interagency policy statement as attached to the board action memorandum.
Thank you. Is there a second to the motion?
Second.
There is a sufficient second. All in favor say aye.
Aye.
All opposed say nay. The ayes have it, and let the record show the motion passed 3-0. And thank you again.
Thank you.
The last item on our agenda today is a board briefing on credit union mortgage rates. Staff presenting, Andy Leventis, Chief Economist. Welcome.
Thank you very much. Good morning.
Good morning.
Over the next few minutes, I'd like to discuss findings from the research paper that my group has provided to you. The paper, which is also being publicly released today, includes a brief analysis of mortgage interest rates offered by credit unions in 2018. The goal of our work was to answer these three questions. In general, we wanted to know whether credit unions were offering different mortgage rates than other originators, whether any observed rate differences varied in rural areas, and finally, whether any observed rate discounts were likely to be just the result of differences in credit risk attributes. The bottom line finding of the report is that mortgage rates for credit union loans were generally lower than for other loan originators in 2018. The result held for the U.S. as a whole, as well as for urban and rural areas separately. Finally, we generally found no evidence that the relatively attractive rates being offered by credit unions were merely the result of differences in credit characteristics. So why did we do this? Why does any of this matter? Measuring the relative attractiveness of credit union mortgage rates is important because, one, comparisons allow us to evaluate the extent to which the industry is serving its members, including those in underserved areas. A strong argument can be made that serving members is not just about being in the right locations and providing a menu of services, but also, in my mind, it's about providing members with attractively priced services. Also, the comparison allows us to better understand industry efficiency and competitiveness. So, moving on to the details of our work, you'll notice that our analysis used loan-level data from the 2018 Home Mortgage Disclosure Act database, also known as the HMDA data. This is the latest available HMDA data set. You may recall that my office, the Office of the Chief Economist, uses different data to publish a quarterly comparison of interest rates for deposit and loan products, including mortgages. We didn't use those data for this exercise because they didn't include sufficient detail to allow us to answer the core questions we're asking here. So using the HMDA data set, our goal was to look at a well-defined sample of relatively common mortgages. To that end, we restricted our work to first lien 30-year fixed-rate conventional mortgages on owner-occupied one-unit properties. As I said earlier, the focus of our work was on mortgage rates. We wanted to compare median contract interest rates on credit union mortgages versus rates on loans originated by others. We also looked at rate spreads because we wanted to evaluate a measure that also included points and fees. As you probably recall, the rate spread is the difference between a mortgage's APR, which includes those factors, and the average prime offer rate. While we were interested in mortgage rate differences, we also wanted to compare credit attributes. After all, a difference in mortgage rates wouldn't be particularly surprising or noteworthy if there were systematic differences in credit quality. For a broad comparison of credit characteristics, we calculated and compared summary statistics using the HMDA dataset, as I said, for 3 credit risk indicators: credit scores, the combined loan-to-value ratios, and the debt-to-income ratios. Moving on, this table shows our key findings. Using a combined sample of purchase money, mortgages, and refinance loans, the table reveals lower mortgage rates for credit union mortgages. At the same time, it shows relatively similar credit attributes for loans originated by credit unions versus loans originated by others. So the lower interest rates can be seen in the 2 green circled columns. The first of the 2 green circled columns reports the difference in median contract interest rates. You can see that for the U.S. as a whole and for rural and metropolitan areas separately, we saw a 13 basis point interest rate discount for credit union loans. In other words, the median contract interest rate for credit unions was about 13 basis points below the median for other originators. The second of the green circles, as you're moving from left to right, shows the difference in the median rate spreads. you can see that this more inclusive measure of rates reveals a very similar level of discount being offered to credit union members. As we moved further to the right in the table and look at the data in the yellow box, we can see no substantial differences in the overall credit attributes of credit union mortgages. At least in this very specific but very large sample of loans, there are no consistent indications that credit union loans had materially better or worse credit characteristics. Credit union mortgages generally had slightly worse credit scores, origination CLTV ratios that were about the same, and slightly better debt-to-income ratios. In sum, when we look at these three final sets of columns, there's no clear indication that the lower contract interest rates and rate spreads that we saw in the previous columns were simply a function of different credit attributes. So moving on, for folks who are interested in looking specifically at purchase money mortgages only, this table provides the breakout. As you can see in the green circled columns, the basic finding here is effectively no different. At the median, credit union contract rates and rate spreads were generally lower by between about 9 and 13 basis points, depending on the geography that you're looking at and whether you're looking at the interest at the contract rates or the rate spreads. Also, in line with what we saw in the prior table, the credit risk statistics in yellow are broadly similar between credit union and other mortgages. In other words, once again, credit union discounts did not seem to be simply a function of differences in credit attributes. Now, just a few caveats at this point. First, as I indicated earlier, our study was limited in scope. We looked at 2018 loan originations of a very common but very specific type, 30-year fixed-rate conventional loans. Second, while the data set was expansive, the underlying HMDA data do not include a universe of all loan originations. Certain smaller loan originators, including depositories with $45 million or less in assets, and those with limited mortgage volumes, did not need to submit their data to HMDA for this era. It's not clear how the inclusion of such information would impact the results. Finally, by design, our report was relatively simplistic. It is far from a comprehensive econometric study that would definitively prove that, all else equal, credit union mortgages were lower in 2018. These caveats aside, I think it's fair to say that the results are strongly suggestive that credit unions are serving their members with mortgage rates that, on balance, are relatively attractive. Moreover, as you know, an interest rate difference of 9 to 14 basis points, although that may seem small, can amount to significant savings for borrowers. For example, let's look at the 14 basis point savings that we observed in rural areas. Assuming a $175,000 mortgage, if the borrower paid a 3.6% rate rather than a 3.74% rate, then over the life of the loan, the borrower would save nearly $5,000. This amounts to meaningful savings, particularly to borrowers who are struggling to make ends meet. Thank you very much for your time, and I'm happy to answer any questions.
Great. Thank you, Andy, for the presentation, but also for your extensive leadership in this effort, and also with your team members as well who put together today's research. I placed this item on today's agenda because my goal for you and your team is to share this research with a broader group of stakeholders who have a shared interest in sustainable home ownership. As you're all aware, mortgage lending wasn't originally a priority for the credit union industry, which in its early years focused on smaller loans to members of the cooperative system. But that story has changed dramatically over the last few decades. In fact, consider the numbers. A couple of decades ago, credit unions played a negligible role in mortgage markets. That's changed rapidly. Today, credit unions hold more than 4% of outstanding mortgage debt in the United States. The credit union industry today is originating more than $190 billion in real estate loans each year, and more than $125 billion of that total is fixed rate first mortgages. The pace of mortgage lending in the credit union industry is also accelerating with growth in the last 5 years alone of more than 70%. Home ownership has long been understood as a key pillar of the American dream for generations of workers and families because it can be such a reliable pathway toward building wealth over time for so many people. Moreover, we know home ownership plays a strong role in building strong communities where people are invested in one another's lives and futures. Communities with higher rates of home ownership are likely to have a larger tax base, higher quality public services, lower crime rates, and greater civic participation in the form of volunteer work and community service. I recognize it's not a silver bullet, but home ownership correlates to a great many desirable social and economic outcomes. That's why it's definitely something we all want to encourage. To that end, Andy, I do have a few questions.
Sure.
It seems like your work could be extended to specifically evaluate underserved communities beyond just rural areas. For example, you could look for interest rate differences for lower income borrowers, perhaps. Is that possible?
Yes, absolutely. In fact, we've done some preliminary work in that regard, and the preliminary indications are that the results will be broadly similar.
Very
In other
well.
words, we'll see significant credit union discounts for lower income borrowers.
We may then be able to invite you back at some point. On a related note, when the HMDA data is released for the 2019 originations, do you plan on evaluating that database in a manner similar to what you've done here for 2018 data?
That's certainly our plan, and I think it makes sense to sort of track this over time for a variety of reasons, some of which I mentioned there.
Very well. And then last question. Suppose we wanted to look at relative borrowing rates for different ethnic groups being served, especially when I think of the 500 minority depository institutions that we at NCUA oversee. Is that something that's possible as well?
Yes, absolutely. So if we wanted to look at MDIs specifically, we could find some of those MDIs in the HMDA data set. Mm-hmm. Obviously, MDIs in general tend to be small, and many of them won't be reporting to HMDA. But if we wanted to look at credit union mortgage rate differences for those institutions specifically, we might start with the HMDA data. Now, if we were looking more generally at minority communities and looking for differences in the rates they're paying in the credit union world versus the banking world, we also can do that, and there are more resources available for answering that very broad question.
Very well. And I do want to just clarify, when you mentioned that some of the smaller institutions would not be using the HMDA data, could you tell folks that they're not eschewing HMDA data, but there's a specific reason as to why they aren't reporting it?
There's very specific thresholds that apply, and smaller institutions, as I said, those with $45 million in assets or less, and those that make relatively few mortgages a year are not required to submit to HMDA.
Great. I just wanted to clarify that.
Yeah, absolutely.
I have no further questions. Board Member Harper.
Thank you, Mr. Chairman, and I want to compliment you for your judiciousness in today's agenda. Not only did you schedule something that appeals to Board Member McWater's inner accounting geek, you've scheduled something that appeals to my inner statistical geek.
Very well. So good.
And
it's a balancing act.
It's a balancing act, and my inner statistical geek was developed at that other college down the road on Massachusetts Avenue. So, Andy, thank you for your informative presentation of analysis conducted by the Office of Economics of 2018 mortgage originations. I recognize that your analysis, which compares interest rates and loan characteristics for loans originated by credit unions and other financial institutions, was meant to be limited in focus and is not definitive. However, as part of my confirmation process, actually, I believe you were asked this question as well, Mr. Chairman. I was asked whether I saw an opportunity for credit unions to provide more loans to people seeking to purchase a manufactured home. Did your research yield any information about credit union manufactured housing loan interest rate differences?
Yeah, so we didn't look at that specifically. When we cut the data to a very specific data sample, we specifically excluded manufactured homes. But that type of analysis would be possible, and we certainly could extend our work to look explicitly at credit union mortgage rates for manufactured homes.
I think that would be some very helpful information to have, because oftentimes in manufactured homes, we've heard about predatory practices where people end up paying substantially higher rates, and it would be good to know what is happening out there in the real world so that we can make better policy decisions here at the board table. Andy, I've also long been concerned that credit unions do not have equal access to the secondary market and are penalized even though they, as you and I have discussed, often have better underwriting standards. Did your analysis yield any information about the quality of credit union underwriting?
So we didn't look specifically at underwriting, but I would say that based on my prior research, which we've discussed, and that credit unions have very solid loan performance statistics. Even if you look at the same credit attributes, in other words, if you look at loans with a given FICO score and within a given FICO score band, within a given LTV band, and with given DTI bands, loan performance for credit unions within that bucket tend to be better than for other mortgages, at least, or for other loan originators based on my research. So what I would say is that the gaps that we have observed in rates here, if we did a more sophisticated analysis, might actually be different. In other words, the rate spread might be even larger. So I guess that's the sort of a long-winded way of saying that we didn't look specifically at underwriting standards or loan performance, but that's sort of embedded within all of this. And you may note that when I did the presentation, I talked in very general terms about credit attributes as opposed to credit risk. And I use that terminology very specifically because, as I said, for a given set of credit attributes, credit union loans may actually have lower risk because of that empirical norm where you see better underwriting and lower probabilities of risk, or of default, I should say.
Thank you. Could we turn to slide 7? One thing that struck me as we're sitting here today, first of all, is that mortgage rates are typically quoted in eighths of a point. And if you look at those numbers, that's roughly an eighth of a point, a percentage point overall. Right. So, I mean, credit unions generally are an eighth of a percentage point better overall in their mortgage underwriting. But also what struck me on this slide, as well as footnote 11 of your paper, is the 5 percentage point difference approximately in the combined loan to value ratio. That's a fairly significant number. Could that differential underscore further cost savings for consumers, given that there is less skin in the game on credit union loans?
So what I would say is when I talked about the differences in credit risk or credit risk attributes in the paper, I said, broadly speaking, the credit union mortgages have similar credit risk attributes. But as you've pointed out here, there are a few dimensions and in a few cases where it looks like they're, or at least on the attributes themselves, may indicate slightly higher risk. Right. Now, whether that translates to higher default rates is a totally different matter. But what I would say here is that what you've observed is the higher CLTV ratios mean that if we were to do sort of a full statistical analysis and sort of do an apples to apples comparison of credit union rates versus other rates, and we were to do a full-blown risk adjustment, then because credit union loans tend to be riskier on this dimension, which is a pretty significant dimension, that gap between the rates might actually be larger. In other words, if you did a full-blown statistical analysis and computed a risk-adjusted difference in rates, mortgage rates, that gap might look even more impressive for credit unions.
Right. That's a very helpful discussion, Andy. Finally, recognizing again that your analysis was meant to be limited in focus on interest rates, we should not lose sight of how important consumer compliance and the economics behind strong consumer financial protection are. Is there data available that shows how much money consumers save by receiving the proper disclosures and not being charged abusive rates?
So that's a great question, and I'm not aware of a specific study on that topic. I would say that there's a lot of room to go for consumer knowledge in the mortgage space. By and large, almost all the survey results that I see indicate that even the best, the most aware borrowers actually are still relatively uninformed. So Generally speaking, there's a lot, I guess one other thing I should mention is that borrowers don't do an awful lot of shopping. And I think only about 50% of mortgage borrowers shop for their rates from more than one or two institutions. So anyway, I would say, as broadly speaking, that there is some data from the FHFA, its national survey of mortgage originations, that indicates that the credit union borrowers as a whole are relatively happy with their borrowing experience relative to other loan originators. Now, unfortunately, those data that I've been looking at aren't particularly fresh. They're from 2016, and I think new data are about to become available. But the good news there is that there's a significant difference in their sort of satisfaction with their lender. Now, that doesn't necessarily mean that all consumer laws have been followed and so forth, but it is a good indication at very least.
And so my takeaways from your answer there are: one, higher consumer satisfaction in credit union mortgage lending,
right.
And two, to quote the great Captain and Tennille, you better shop around.
That's fair to say always.
Thank you.
Thank
I have
you.
no further questions.
Board Member McWaters.
I don't know how I can follow that. I don't know if I want to.
How about a Muskrat Love reference?
Oh, geez. All these Pink Floyd lines are going to my head, and I'm just, okay. Dr. Leventis, I saw a pricing report published by Fannie and Freddie talking about 2018 loan originations, and these things are never crystal clear to me, okay, but I thought maybe I would ask you that when I looked at it, it seemed to indicate that smaller financial institutions were getting worse execution pricing than larger institutions. Is that?
Yeah, so I'm aware of that study, that guarantee fee study. It's published by FHFA, but it's based on Fannie and Freddie pricing data for 2018.
Okay, yep. So when I look back on prior work and the like, when I see a poor pricing execution, I think there are a couple of factors there. One is quantity and one is risk. And so I can see how maybe a large bank would come in with a lot to securitize with Fannie and Freddie quantity. And credit unions or community banks, just by definition, are not going to have the quantity, and that there being a discount, in effect, granted for the quantity, which the big banks have, the credit unions don't. I mean, is that part of it? Or has that historically been part of it? So
historically, that's been a problem, certainly a challenge for credit unions and other loan originators to get fair pricing in the secondary market. And I did, as I said, I did see that study, and I was sort of, when we conducted our analysis and we had that study in the back of our mind, I did find it particularly notable that we saw, despite if we cut the data to just Fannie Mae and Freddie Mac deliveries from the credit unions, we still saw significant discounts in mortgage rates, despite the fact that this other study seemed to indicate that their secondary mortgage pricing wasn't particularly attractive.
Okay.
So anyway, yeah, that's.
Okay. Has FHFA done anything with respect to the quantity issue?
Yeah. So my recollection is that last year they issued some type of directive to Fannie and Freddie to have them stop volume-based discounting. Okay. Now, of course, ultimately whether or not that gets resolved is a function of Fannie Mae pricing strategies, Freddie Mac pricing strategies, and of course FHFA's policies.
Okay, so let's assume that the volume-based problem is fixed.
Okay.
But anytime you see a poor pricing execution, I not only look to quantity, but I look to risk.
Right.
What's the risk base of the stuff going in that's being securitized by Fannie and Freddie?
Right.
And from what you just indicated, based upon Board Member Harper's question, it seems to be that the paper that is going to Fannie and Freddie from a credit union or perhaps a community bank may be lower risk than other paper going in.
I think that's a reasonable assumption based on the aggregated data that I've seen, and getting appropriate compensation or price discounts based on superior loan performance is a real challenge for anybody, including credit unions. Absolutely.
Okay, so you said that again on this pricing protocol or methodology, that on the quantity side there may be some movement, some improvement, but on the risk-based pricing element, meaning the paper that the credit unions put into Fannie and Freddie is less risky, is there any movement there to?
Yeah, I'm not an expert, but I'm not aware of any movement in that direction. But it's certainly possible.
Well, to me, when you talk about something to be very, very, very meaningful to credit unions, getting a better execution price on the paper that you sell to Fannie and Freddie, and others, I think, follow what Fannie and Freddie are doing.
Right.
Would be critically important to the credit union community as far as saving money and being able to use those funds for members and other programs within the credit union. So if nothing is being done on the risk-based element to this, is it possible to have discussions with the FHFA and bring this to their attention? I suspect they're aware of it, but
right. So obviously they and Fannie Mae and Freddie Mac separately are key players in this, and then the other thing I should say is obviously there's the whole issue of mortgage finance reform, and the finance reform, the rules and the laws that are passed based on the way Congress wants to make the new secondary market look like. Hopefully would accommodate a pricing structure that gives credit unions and others with superior loan outcomes some type of credit for that.
Okay. But from what we have now, the way the rules work now, it seems to me that it would be helpful if you or other people from this agency meet with Fannie and Freddie and discuss this issue, because if we could get pricing execution based upon the risk of the paper that credit unions are putting in, which to me it seems like the fair way to go. It's a market-oriented approach. That would be hugely beneficial to credit unions.
I think that's fair to say, and it's also there are elements to their charters that would be sort of hooks that would seem to mandate that they pay attention to the higher quality that the credit union mortgages are, and that are probably being delivered to Fannie and Freddie.
Okay. Thank you very much. I have no questions.
Thank you, Mr. McWaters. I share that same concern. In fact, we are working to have a meeting with the head of FHFA to discuss this, among many other topics regarding credit unions and the asset quality of the mortgages that they are presenting to Fannie and Freddie. So very timely that we're having this discussion.
That's fantastic.
Thank you again,
Great.
Andy.
Thank you very much.
That is, ladies and gentlemen, the end of our agenda today. There being no further business, we are hereby adjourned and the board will move to a closed session. Meeting adjourned.